Hello, everybody. Today, we'll be doing a panel on the valuation problem. How do you price a protocol? In my opinion, as somebody who's been in crypto for a little over 5 years now, this is probably one of the most interesting problems. There are some tokens, as you've seen, that have no cash flows and are worth $10 billion, and maybe some tokens that have a ton of cash flows and worth $200 million. So I think one of the questions we want to get to the bottom of today is kind of what begets these valuations and how does the market perceive certain assets. Before we get into that, I want to give our panelists an opportunity to do a round of intros.
Thank you, and thank you to the TIE for having us. My name's Andrew Moss. I'm the head of digital assets research at Jefferies.
Hello, everyone. Thanks for having me. Dave Sedacca. I lead Polkadot Capital Group's the IR and capital markets arm of Polkadot. Polkadot's a leading blockchain infrastructure platform founded by Gavin Wood. He was the co-founder of Ethereum. He created the EVM and Solidity smart contract language. And what we do here is to help educate and provide confidence to institutions on how you educate with blockchain infrastructure, protocols, and digital assets as a whole.
My name is Jascha. I'm one of the founding partners at Greenfield. Greenfield is a venture firm that was started in 2018 in Berlin. We have been investing through an early stage strategy and a liquid strategy over the years, anything with a very broad scope, anywhere from crypto consumer applications, DeFi protocols, and obviously also opportunities deeper down at the bottom of the stack, mainly in the Ethereum ecosystem. And we run a lot of infrastructure in some of the networks that we invest in. We are active liquidity providers, so we do try to be, I guess, active users in some of the protocols that we invest in.
Hey everyone, my name is John Phillip. I'm one of the co-founders of Areta. We're an investment banking M&A advisory firm in crypto. Prior to that, I used to work at Blackstone in their private equity group. And one of the reasons why I left Blackstone to start Areta was also to figure out what deal making and valuation could look like in the digital assets world. So really excited to discuss it today.
Awesome. And my name is Arnav. I'm a partner at Bankless Ventures. The same as the podcast, for those who are familiar. And we're a $50 million early stage venture fund, just looking to back the next generation of really cool stuff in crypto. I guess on to the first question. Very high level, how do you think a protocol should be valued? Do you think it should be a DCF, cash flow multiple, comparable assets, or more broadly, what is your mental model for how you would price a protocol?
Sure, I can kick it off. So over the longer term, I think that obviously cash flows are all that matter from a valuation perspective. The problem with looking at cash flows today is that I don't think that they are predictive of cash flows tomorrow or over the near term. So if you just take 3 blockchains, Ethereum, Solana, and Tron, they've generated about $70 billion since 2021. But if you just look over the last year, Ethereum's revenues are down about 70%, Solana's are up 70%, and Tron's are up 140%. If you look at a price to sales multiple, Ethereum's at about a 500 times sales, Solana's at about 100, Tron's at about 10. So if you're an investor, you might say, well, short Ethereum, buy Tron, but I think that would be a little misguided. Now, part of that is because if you look at Tron, about 85 to 90% of their revenue is driven by Tether gas fees. Now, Circle pulled out of Tron last year. I'm not saying that will happen, but it certainly could. So there's certainly a lot of concentration risk for Tron. So I would really value or approach valuation of protocols really as early stage tech startups. And I would be far more interested today in KPIs that gauge adoption, usage, development than I would in looking at the revenue today. And thinking about Ethereum, just to end this, is that Ethereum has almost intentionally decreased the revenues to prime it for future growth. So I just think it's really important that cash flows do matter over the longer term, but right now I think it's going to be missing the next leg of growth if you're just looking at revenues or cash flows more broadly.
Yeah, I think to add to that, and you're right, like Ethereum transactions fees dropped dramatically, right? You can't pay $100 per transaction fee to be sustainable. So I think in Polkadot, or if I think about protocols in general, they're all not the same. So Polkadot is a layer 0. It is the foundational technology, and it's the utility of the token to support the ecosystem, right? How is that token used? And for example, we commoditize block space. So you need the DOT token to purchase block space. You hold the DOT token to secure the network. So I think it's about the long-term value proposition of the utility of the token, which is different versus if I look at like a hyperliquid.
Yeah, and I guess maybe from our perspective, what I would add to that is there's one thing I think we need to understand when looking at protocols, especially when we compare it to valuing equity businesses, is that if you think about the traditional company, let's take Uber as an example, right? Between seed to the time when it went public, it's probably at least a decade of time for that organization to mature, to expand to new markets, drive revenue, grow, scale, and really de-risk the organization. I think the fundamental difference here that we need to understand when we're looking at how to value these new organizations is that by the time a protocol goes public and launches its product, and with that, in many cases, the token has to come to life, it is a much more nascent and young and fragile organization. In some cases, it hasn't even found product market fit. And I think that is something that we fundamentally need to understand. So for us, the way we look at it is that, on the early stage side, obviously, if you're investing before something is live, it often comes down to the team. You try to understand, is this an amazing team that is building a solution to something that is a big problem? But as we enter, stages where there is traction and you can really dive deep and understand, what is happening on chain, we use valuation methods and frameworks, but more as a sanity check, just to understand that, what are the drivers, what are catalysts, what is the revenue composition looking like, and also how sustainable is the actual usage. So that is, I think, an important exercise, but we don't try to overemphasize on these type of frameworks.
Yeah, maybe to round this up, I fully agree with you, Jascha, that valuation multiples and more fundamental valuation methodologies can make sense as a sanity check when valuing a protocol. But historically, the market has not really been fundamentally efficient, and so it's been really, really difficult, I think, especially nowadays for institutional investors as they enter the category, to run valuation analysis and benchmark on a comps basis within the space, but then also against traditional companies. There's a lot of new things to consider, such as what are actual revenues, adjusted for maybe fees you have to pay to miners, stakers, liquidity providers. So there's a gap between gross revenues, net revenues. Obviously, token emissions, vesting, unlocks are fundamentally different and very specific for each protocol and different than stocks, for example. And so a lot of different things to consider when valuing a token, and probably in the current market, it makes most sense only as a sanity check.
Awesome. Next question I have is, what do you guys think is the optimal use of revenues for a protocol? Like, it sounds like a very obvious question. Like, obviously, we're going to use our revenue to grow our company, right? And then maybe at some point in the future, we'll do dividends, right? But in crypto, you look at like Hyperliquid, which just surpassed the NASDAQ in terms of market size, and they're using their $1 billion a year in revenue to buy back their own token. Which is actually a really interesting phenomenon. It's worked very well so far. So I'm kind of curious, do you think buyback and burns are the optimal use of revenues, or what do you think would be? And I'll start on the other side this time.
Yeah, I think, look, buybacks can make sense, similar to stock buybacks in the traditional world, when you think, for example, that your token is undervalued and you have excess cash and no better ROI for deploying this cash. So this could be the case for more mature, really high cash flow generative protocols. But I guess for the majority of especially earlier stage protocols, you would rather want to invest into the product development, sales, GTM, before really considering buybacks or burn mechanics.
Yeah, I would agree to that. I think what we've seen this year in the absence of significant inflows, either coming from retail or institutions into anything downstream of, maybe a handful of majors, that in some cases, protocols became the biggest natural buyer of their own tokens. And then you brought up Hyperliquid. I mean, that's a perfect example. But I think Hyperliquid is also in a very unique and privileged position when it comes to their balance sheet and also, just I guess how solid and how strong Hyperliquid has been growing from a revenue perspective. And I think on top of that, what is unique about Hyperliquid, that obviously they were not hit with any supply overhang from previous funding rounds and other kind of earlier contributions. So I think that put them in a very unique situation. If you look at that, most of the other buyback programs actually really haven't yielded. Even in the case of Pump.Fund with, I believe, 1 million per day that are putting towards buybacks, you can argue that it hasn't really worked out, at least not to the extent as Hyperliquid has worked out. And then to JP's point, I would fully agree that, especially in the early stages, as with any traditional early stage company, also outside of crypto, investors don't expect dividends or returns so early on. I think in many cases it really makes sense to reinvest margins and profit back into growth and capturing bigger market share.
Yeah, I think it really comes down to the maturity of the protocol. Where are you in the life cycle of growth and stage? So if you look at something like Curve Finance, they have VE model, right? So vote escrow. You get more incentives by locking up your token, so you have long-term value proposition. You're contributing to governance, and then you're also kind of locking up that token, right? So no sell pressure. I think buybacks and burns are definitely a great vehicle to generate revenue for the ecosystem, but I don't think it's an end-all be-all. If I think about Polkadot today, Polkadot's an inflationary token. 85% of those of the inflation gets paid out to the validators and nominators to secure the network, while 15% of that goes to the treasury to fuel growth. We burn all the transaction fees on the network. We burn all the fees when you purchase block space. But this is evolving. Polkadot, we're going to be launching a Polkadot hub, so it's an EVM compatible DeFi. And that's where we're going to be capping supply in Q1 next year. So this inflation is going to go away. So we have to think about how we bring value back to the token holders and generate revenue for the ecosystem.
Yeah, so I think these are all good points I agree with. So I think that the burn model aligns a token holder's interests quite well with the management. As David was just saying, many of the labs and foundations also hold a significant number of tokens, so they also are incentivized to drive value. You also have to remember that these aren't public companies for the most part, so there's no earnings call every quarter where investors can ask questions. So, in lieu of that, I think that the burn model works quite well. New models are emerging. Chainlink's Chainlink Reserve model is somewhat of a hybrid, which is somewhat interesting, but as of right now, the burn model seems effective to me.
Awesome. So there seems to be some kind of consensus that yes, the burn model is good, but also you should only invest in the burn model after you've reached a certain level of maturity in the protocol. I think one really interesting thing to watch after this is when Hyperliquid launched, and a lot of the new protocols, they're doing 100% burn kind of on day one with revenues, and it's almost what retail and a lot of even VCs have come to expect. So it'll be interesting to see kind of this battle between when people will do full buybacks and then when a protocol also reaches maturity. I think that tension will continue to exist. Moving on to the next question, how are you guys thinking about value accrual to the token versus the equity? A very good example is Uniswap. They just announced their fee switch. They do like 9 figures in revenue. They're now accruing all that value to the token, but for the past 5+ years, all of that value has actually been accruing to the equity portion, even though the token has been at a $6 to $10 billion valuation. So I'm kind of curious, how do you guys think about that? And when is the right time for a founder to push value to the token over the equity?
So maybe a different answer, but I don't really care. So as long as there's transparency into where cash flows are going, whether to the token holder or to shareholders, I'm fine with that. I just need to be able to tell. And if you're the management of a protocol and you're prioritizing one over the other, you're going to have problems anyway. You need to drive value to both. You brought up the Uniswap fee switch. Now that's interesting because my guess is that many people that bought Uni over the last several years were unaware that there was really no connection between the price and the platform. Now, but I mean, who's there has to be some responsibility on the investor. I mean, it was very clear in the V1 white paper that there was no connection. And so if you're an investor, you have to do your homework. But I mean, again, as long as there's transparency, it doesn't make much difference to me.
Yeah, I think when you're investing early on in a project, you have the opportunity to have equity. You have the opportunity to have equity with the SAFT, right? Simple agreement for future tokens. But look, in the early stages, those equity investors are fueling the growth of your business and contributing to the foundational technology that you're offering. But I believe when these protocols begin to become more decentralized, they actually get they're bringing a value proposition to the goods and services that they're offering. That token is going to be very important. And I think once you get that inflection point, whatever that KPI is for you as a business, thinking about is it user growth, is it revenue growth, et cetera, I think that's when you start to shift into more of that token support. But you're also creating value for the underlying equity holders at the same time.
Yeah, I agree with those points. Transparency is important. But I think ideally, what is also important is that incentives are aligned, and as long as incentives are aligned, we want the team and the founders to have the flexibility to let value flow to either of these two instruments, depending on what they think is best for the product. The reality, though, at least so far, and I think maybe this week, what we're witnessing is actually potentially new paradigm with, to the degree that founders are actually willing to experiment with business models into the token. Obviously, under previous regulatory regimes, both here in the US and also in Europe, founders were very constrained to let value flow directly to the token. I think that is what then led us to have misaligned incentives in many cases. So ideally for us, we do want to have the founders. The founder thinks that the best way for them to capture value is to just launch a protocol and then offer value-added services on top of it, then that should be absolutely possible. And I think it really depends on what is best for the product. And luckily now, it seems to be a new, phase in the market where we'll hopefully see enough and more of these experiments around kind of token-based revenue models.
Yeah, I think the value accrual topic is actually one of the biggest problems in crypto nowadays, because unlike in the traditional world, you actually have those two instruments, equity and token. And especially in previous cycles, a lot of attention for protocols was on the token because tokens oftentimes did perform well. And there was also not really a path to liquidity for equity, right? There was not really an M&A or IPO window before. And so most of the focus was really on the token. And for investors, it's become obviously very difficult to underwrite tokens because you basically need to take assumption on economic rights potentially in the future, back to our point on revenue profit distributions. And so for investors, it's really challenging to form a view unless there's regulatory clarity. And for teams, I think it's also very confusing because either you're going to fully focus on the token, which most people say it becomes essentially your product, or you see more of your value accrual on the equity side, in which case, that fundamentally shifts how you run the business and, where you see a path to exit in the long run. And so I think especially this interrelationship between equity and token is something we as industry have to figure out, especially now where, traditional capital markets, IPOs, M&A have become really relevant in this cycle.
Awesome. So I think there's this broad agreement we've come to some extent that revenues on chain, relatively good, buybacks, potentially good. So, and we also agree that revenues are a reasonable way to actually value a protocol in and of itself. So under that, assumption, I think the next really big thing to talk about is how do you measure the quality of revenue? And I think to add some more context to that is not all revenue in crypto is created evenly whatsoever. A great example is a lot of the new DeFi protocols that are upcoming. In order to attract liquidity, attract traders, attract users, they offer a ton of token incentives to get these actors to use the protocol. The issue with that is that when the incentives run out, the capital is very mercenary and it leaves. But the revenue on a 2-month basis might have hit like $100 million run rate. So maybe you got a discount for that. Another great example is Pump Fund, which is a meme coin launchpad, which only really works really well in like a bull market, and you can see it get to hundreds of $1 million in run rate. But again, in a matter of a week, it could drop to just 1/100th of that. So that's a long way of saying, how are you guys thinking about quality of revenue? How would you measure that? What other heuristics do you have in mind to think about these things?
Yeah, I can start. It's also a very good topic. And it's a problem that also to some extent exists in the traditional world, where you want to diligence quality of earnings, revenue recognition, and things like that. In crypto, indeed, a lot of the revenues can be sort of subsidized and derived from short-term token incentives, in which case you wouldn't really underwrite long-term revenue sustainability for some of these protocols. So that's a really important part to consider when looking at revenues for protocol. Then back to my previous point, every protocol generates gross fees similar to maybe a centralized exchange. It has gross trading fees and revenues. But then you really need to understand what are the net revenues accruing to the protocol that eventually accrue to the token holder as well. And I think this is something that's fundamentally different than in the traditional world, where you have contributors to the protocol in between stakers, miners, liquidity providers, if it's a DEX, for example. And so really understanding the quality of earnings, what are gross fees versus actual net revenues, I should use as a basis for protocol valuation. And then secondly, of course, how long-term sustainable are those versus short-term subsidized by a token issuance, for example?
Yeah, to add to that, I think the beauty about crypto is that if you know how to look and where to look for, the data is all in front of you, right? So we don't have to ask anyone, it's all on chain, so you can plug into the network and just dive deeper into what's actually happening in the protocol for us. Again, depending on obviously the stage in which we invest at the specific opportunity, we do tend to go really deep on the data. We look at the revenue composition, as I mentioned earlier. We try to understand the different revenue streams, the drivers. We look at what JP also mentioned, capital efficiency, so margins. And if even there you can see vast differences. We just recently did a deep dive on lending protocols, and you can see that there are certain protocols like Fluid, for instance, that do have a much higher percentage of revenue that they generate per dollar TVL deployed into the protocol. So there are these things that you can uncover and discover once you dive deeper, or like also besides sustainability and I guess distribution of revenue, also to what extent is it cyclical and what does it correlate with? We have another company in our portfolio called Sedacca, which operates a block builder on Ethereum. And so it's a function that basically takes transaction, constructs a block, and hands it over to validators. And they, on October 10th, when during the market crash, throughout that afternoon, they generated 3 to 4 million in revenue. So I guess these are the things that we try to look at. What are the dependencies, and how do we construct a portfolio with things that are ideally correlating in terms of their fundamental outlook with different things that can happen in the market?
Yeah, I think quality of revenues across different protocols, right? I think you have the meme coin era, where I look at that as more experimental revenues versus core foundational protocols. And if I look at an L1 that builds on Polkadot, mythical games, I think a lot of the mind share today has been stuck on DeFi. But through regulatory clarity, through adoption of actually bringing other business models on chain, you have mythical games that has done 18 million of revenue year to date. And this is through gaming and NFT trading cards, right? And I think eventually what that's going to then turn into is a creator economy. Users being able to kind of create their own in-game assets, share the revenue, and kind of give that back to the token holder. So I think if we start to think about quality revenue, that's sticky, it's sustainable, more users, more gaming, more development, and that's different from just trading on a protocol. And I think we need to start looking at what this foundational technology can offer beyond just another DeFi smart contract chain.
So thinking about the quality of revenue, I think the question also often becomes, how much of revenue is driven by speculative activity? But I think it's probably the wrong question. The question is actually how much of the revenue is sustainable. So if you think about the Apple App Store, Apple generates a ton of revenue through in-game purchases. Now, I mean, that is sustainable. I It's not something I do, but I don't think that anybody's arguing that getting like a new sword is some sort of great use case, but it drives revenue. Now, if you think about Solana generated $160 million in Q1 through gas fees from Pump.Fund, which you mentioned, and Radium, a decentralized exchange. That's very real revenue. The problem wasn't that they generated $160 million. It was that in Q2, people got tired of generating, the Andrew token and other tokens, and revenues dropped from 160 million to about 20 million. So those are all very real revenue. The problem wasn't, the revenue itself. It's that, it obviously wasn't sustainable.
Totally. So I think to kind of summarize to some extent, the two most important things to think about when it comes to revenue is what is the stickiness of the revenue, which, as we've seen, revenue is not super sticky across most crypto apps. And then the potential growth outlook is probably the two key heuristics maybe I'm sensing are the best to value a protocol. I think the other really interesting delineation to make is that there are many ways to value a protocol generally, depending. So a great example is like Aave, Athena, Maker, these DeFi tokens with high cash flows. That could be one, there's one way to value those tokens, whereas valuing L1s like Solana, Polkadot, Ethereum, that's like an entirely different, set of beliefs on how to value that. And then you have like the ETH is money crowd, and there's a lot to unpack there as well that's kind of separate. Maybe the last question, because we have about 3 minutes here, is all in all, where do you think the token market is heading? I'm less so asking about bull or bear, but more so asking, are we kind of headed toward this world where tokens become almost pseudo-equities, or more so where they're valued by other metrics? But curious to get any insights on that.
Yeah, I can start. I think in the long run, it's going to be the latter. Probably in the short term, there's still a lot of reliance on liquidity cycles, token narratives, and so on that drive token prices really in the short term. But in the long term, and what we're already seeing now compared to the previous cycle, for example, is that there is a lot more attention on metrics that also matter for equities, really. And so I think tokens are going to become much more similar to equities in the long run. And I think back to my previous point, what's really important is to figure out this interrelationship for protocols. So how do you really make sure your value accrues to your ultimate token or equity holder, ideally to both of them in a balanced way. But I think in terms of the overall underlying metrics and sort of characteristics, token are going to become more similar to equity.
Yeah, I would fully agree. I think, as I mentioned earlier, we are probably going to see a lot more experimentation from founders around, token models and infusing a business or revenue model into token with, obviously a different regulatory environment and hopefully less constraints or more flexibility. I would also hope that we are going to see more sophisticated investors that, generally understand that protocols do have, you can look at a protocol like looking at the company's P&L, and you can analyze and monitor all the different things that we talked about today, from revenue sustainability and distribution and all these different things. And the best thing actually is that it happens all in front of us, and it is 24/7 live on chain, and you just need to plug to the network and start diving deep on the data.
Yeah, I agree with you guys, and JP as well, right? I think people are asking tougher questions these days, so we have to really kind of figure out where do each of these protocols or tokens stand and the true value that they're bringing to the users or the business itself. And I think from a Polkadot standpoint, like I've talked about before, it's understanding what the utility of the token is today and where it's heading. And look, we're 5 years into a lot of these differentiated protocols. We're actually just getting some regulatory clarity. We're actually put some of these protocols to use in ways that we've never seen before. So, as we've talked about, there will be other opportunities to think about what you do and get creative with generating revenue for the underlying business and token as a whole.
So my view is that we're approaching an inflection point in institutional entrance and investment. And along with that, I expect that you see a shift in focus from speculative token trading to fundamentals. Now, the longer term implication is that you see token price divergence, which we've actually seen since 2021, but that divergence really accelerates.
Absolutely. Thank you guys so much. That was a super interesting panel. That's all the time we have today. Please give our panelists a hand.